welcome to EPRA's Myth Buster podcast that aims to bring you important thinking on European listed real estate from sector expert investment specialists. We're driven to highlight the importance of European listed real estate within a sophisticated investment portfolio. And we're convinced one of the best ways to achieve this is by giving a forum to those specialist listed real estate investors that are willing to offer their time and insights on the sector. I'm delighted to be joined by Jacques Perdrix, Portfolio Manager of Public Real Estate Equity Europe at Heitman. He will look at the sector within the current macroeconomic environment and also explain the house view on listed real estate within a sophisticated real estate allocation. Jacques, many thanks for joining me today. Let's dive right into the big questions of the day. Higher inflation and interest rates are a hot topic globally in investment at present. Please could you explain how Heitman views the situation from a European listed real estate investment perspective?
In times of turbulent market conditions, I'd say stay calm and carry on, like the French say, and everything's gonna be fine. The message is REITs can still deliver positive performance in rising rates regimes. Typically, they would trade well against equities in flattening curve environments, but less so in steepening ones. But they don't generally trade negatively. However, there is no meaningful long-term relationship between REIT returns and long-term interest rates. Actually, if we look at long-term correlation, it's close to zero. What we've done though is we've looked at break-even inflation linked rates to see if there was more correlation to the asset class, and actually there is. We see more stable, positive relationship over the long term. Now, looking at inflation expectations, when they are rising with bond yields, as a result, REITs usually tend to move higher and are a better, investment opportunity. And it can be illustrated by, the recent survey that was put out by EPRA analyzing the impact of inflation on listed real estate total returns, whereby you can, see that a 100 basis points increase in the yearly inflation rate will have a positive 29 basis points impact on UK listed real estate equities, 33 basis points on Swiss, and 108 basis points on Swedish ones. One of the main reasons for this outperformance is basically the inflation protection of leases tied to real growth or inflation linkage that provide a hedge to rising operating and financing expenses if inflation continues to increase. This is even more relevant if you look at Europe, as the inflation linkage is stronger than any other regions. Heitman research estimates that more than 50% of all European leases are linked directly to inflationary adjustments in their reviews versus 40% globally. Europe typically features annual rent reviews that are fully indexed to CPI, when Japan boasts 5-year rent reviews based on market evidence, and the US has yearly reviews with fixed rate step-ups. Another positive point we think is that the leverage of the European REIT sector is historically low. Green Street estimates that the ratio of net debt to the market value of assets is in about 41% right now. On top of that, 85% of the outstanding debt out there is fixed for an average duration of around 6.2 years at an average interest cost of 1.7%, limiting risks to interest rate sensitivity and refinancing. Then we can also look at the serviceability of debt and ability to pay dividends, and that remains quite strong in this environment. The payout ratio of dividends to cash earnings is around 78%, implying that there is sufficient buffer to support cash distribution to investors, and the sector currently trades at an attractive 4.1% dividend yield, which is in the higher range of the historical trading range. Lastly, REITs are unique because they pay around 90% of their taxable income to investors, so high yielding asset class by nature. And this is also supported by a very strong cash flow generation of around 4.6% according to 2022 estimates.
Looking at European listed real estate, what do you believe the opportunities and issues are compared to historical valuations, other investment opportunities and other equity sectors?
So in rising rates and inflation environments, where we are right now, we would prioritize listed real estate sectors with strong underlying growth fundamentals that have large supply-demand imbalances, assets with short lease durations, and liabilities with longer-term fixed durations. Those sectors can provide the opportunity to regularly reset rents to prevailing market rates while slowly repricing higher capital costs, hence creating superior cash flow generation in the short term. Now, if we look at the European listed real estate space, high quality or diversified office names offer strong risk-adjusted returns, we think, since they are trading at a historical high discount to their intrinsic or private market valuation. In the case of offices, this has led to many take-private opportunities over the last 2 years. Retail is also highly discounted relative to its inflation linkage, its sensitivity to the macroeconomic and consumer spending recovery, private market valuations, and healthier balance sheet leverage, especially compared to the last couple of years situation. Now, if we look at European listed real estate performance relative to other investment opportunities, such as bonds and equities, we observe that the asset class has generated superior total returns under low to moderate inflation cycles during the last 20 years in the Eurozone and around 30 years in the UK. However, REITs might not outperform equities in the short term due to the lag in repricing inflation relative to other asset classes, especially cyclical equities such as financials. But when we look at the opportunity set relative to fixed income opportunities, clearly the income streams from real estate can rise over time, especially in inflationary regimes, which basically provides better risk-adjusted returns.
How do you look at European listed real estate opportunity set relative to other geographic regions?
So we look at it from a supply-demand growth standpoint and also valuation standpoint. So if we look at the supply-demand side of the equation, the planning regime significantly restricts supply in Europe, where we have seen supply ratios of about 0.4 to 0.8 times in most asset classes, with the exception of logistics that experience robust supply rates. Europe, as discussed, also boasts superior inflation linkage more than any other regions, with typical annual rent reviews fully indexed to CPI. And given the path of inflation expectations that we are seeing in Europe, that creates significant growth, organic growth opportunities. In addition to that, the emergence of specialty real estate is also very interesting because it only represents 9% basically of the listed space in Europe versus 48% in the US. And we think that is also going to drive market growth going forward. And lastly, valuation. If we look at European listed real estate spreads relative to local corporate and government bond yields, this remains at historical highs from an absolute and relative standpoint, with around 300 to 400 basis points spread for Europe and 200 to 300 basis points for Asia and the US.
And finally, moving the discussion on to European listed real estate as a vital component in a client's real estate portfolio. How do you take account of complementarity across listed real estate debt, and unlisted real estate within their portfolio?
So our research shows that the REIT completion portfolio with underlying exposures to alternative sectors can complement private real estate portfolio with the potential to improve returns and dampen volatility. Investors can also achieve additional diversification benefits within their real estate allocation by holding REITs. And in fact, we found that even a modest tactical allocation of 20% to the public markets may lead to improved returns compared to an allocation exclusively to private real estate. On top of this, REITs provide a liquid solution to access alternative sectors such as data centers, self-storage, and student housing. Those sectors are underrepresented on the private side. 61% of the public market allocation globally goes to these alternative sectors versus 5% on the private side. They have also generated superior long-term returns. If you look at the last 10 years, the annualized total returns for the REIT alternative sectors were around 15%, 1.5, when it was 11% for the FTSE All REIT Index and about 10% for the ODCE Index that measures performance of open and diversified core equity funds. Listed real estate also offers access to a wide range of investment opportunities within single vehicles, such as diversified REITs. Those vehicles allow for diversification within real estate portfolios by defining property strategies, both in terms of geography and property sectors, and also in terms of investment style. Lastly, I think what's important to remember is that listed real estate offers core or tactical capital allocation opportunities based on significant public-private market valuation dislocations. In the listed sectors, trading at a premium valuation, such as specialty real estate, offer exit opportunities for private real estate via primary listings, for instance. On the flip side, listed sectors trading at a discount valuation, such as offices or residential, offer entry opportunities via take-private deals, as illustrated by the recent buoyant M&A activity we've seen in the space.
EPRA produced research on the impact of inflation on the sector earlier this year and has recently produced research on the impact of inflation and interest rates on the listed real estate sector and real estate more widely. I'm sure we'll hear more on both topics at the EPRA annual conference taking place in Paris on September the 6th to the 8th. We look forward to welcoming EPRA members for property tours on the 6th and the conference day proper on the 7th. We'll also open our doors to non-EPRA member investors, joining our members on September the 8th for Investors Day, where we'll have 5 thematic panel sessions with company and investor participation and the opportunity for investors to meet those companies presenting. We hope you've enjoyed this brief insight and we look forward to you joining us for the next discussion in this series on European listed real estate.